how's this stress test different? And can we start to calculate how much I would actually save from something like what was announced literally yesterday? What was it, February 18th by Trudeau and Finance Minister Morneau?
You don't save anything. You get to have a bigger mortgage. Theoretically, you get to have a bigger house.
Hold up.
Okay. Well, we're live here with Ron Butler from Butler Mortgages. The man really needs no introduction, been around for a long time, seen a lot of things, and you're the first person that I thought about when I was thinking about who should I talk to about this new stress test change everyone's talking about, but I'm not sure everyone really understands exactly how it's going to work and where it's all going. So would love to dig into that today, Ron. Real quick, I know you're big on Twitter, so why don't you give us a tweet about what you're all about at Butler Mortgages?
What we're all about? We're discount mortgage brokerage. We reduce rates at our own cost so that we can pass on the lowest rates to the consumer.
Got it. Simple enough and compelling enough, I think, for a lot of people, because people obviously want to save money. Now, you guys are also very knowledgeable, especially yourself, right? So why don't we talk about this new stress test? Let's say I'm a first-time home buyer. I'm getting a $500,000 mortgage, and I'm kind of familiar with how the stress test, I guess, is right now. There's the benchmark. It's something around 5.19. How's this stress test different? And can we start to calculate how much I would actually save from something like what was announced literally yesterday? What was it, February 18th by Trudeau and Finance Minister Morneau?
You don't save anything. You get to have a bigger mortgage. Theoretically, you get to have a bigger house.
Okay.
So the idea of the stress test was originally proposed as a method to protect people in a low interest rate environment. What will 5 years from now when you have to renew your mortgage and the rate may go up significantly? For the sake of argument, let's say rates are 2.39 today. Happen in 5 years if they were 5.39. Why they use the word stress, because that would be a bit of stress. If you had to and suddenly increase your mortgage, because that would almost, not quite, but it would be about a 75% increase in your mortgage payment.
Sure.
For 2.39 to 5.39. Even when they were proposing it in 2016, they knew it was a lie. They knew that rates would never go that high. They told the story of trying to protect the public because that's an easy story to sell. That's something that everybody can buy into. But the truth is, they knew even then that the rates will never go that high, and they have no expectation of going that high. And guess what? They didn't go that high. They didn't even come close. They didn't even really go up much. Let's introduce the stress. So what is the stress test? The real behind the stress test is to try to slow down lending. Designed, we call it a drag on lending. So that if you want to refinance your house, if you want to buy a new house, that you couldn't get as big a mortgage as would in the normal world. Because for the previous 165 years of mortgages, whatever the hell the 5-year contract rate is, you could have that rate. That's your rate. That's how we base all our calculations. You're paying 2.39. That's how we're going to calculate this, is 2.39. In 40 years. That's how it's going to go. Drag on lending. It's all about finding a way so that people couldn't borrow as much as they may wish to. That's all. The old story about protecting you in 5 years, utter bullshit. And they knew it. So why do they want to slow down lending? They were worried. I mean, went through the. You're in Vancouver, right?
Yes, in Toronto.
You're in Toronto? Okay. So in Vancouver, went through the roof. In 2015 and 2016, prices went through the roof. At the end of in the whole year of 2016, in the 416 area code, the average increase of the house price was 30%. They just had a strong desire to pull that back because it's unsustainable. It's dangerous. It's dangerous for the banking system to be financing these rapidly expanding house prices.
Mm-hmm.
So that was their whole intention, slow down lending.
Mm-hmm.
Came up with a stress test, and it worked. It worked to a certain extent.
Mm-hmm.
To the idea that it's designed to slow down lending, to make you borrow less, force you to borrow less
Mm-hmm.
from a federally regulated financial institution, yes, it forces you to borrow less. Interestingly, the provincially regulated financial institutions, such as credit unions, they may not employ the stress test.
Right.
They're not necessarily required to.
Hmm.
So that's the whole story behind the stress test.
Mm-hmm.
What happened yesterday? So yesterday, the prime minister during the course of the election campaign that he would take in hand the need to help first-time home buyers, new home buyers, young home buyers. It was an election campaign promise.
Mm-hmm.
So this is his shot at delivering on the promise. Again, just a lie. The difference between 5.19 and the 4.89 that the new system would employ today,
Okay.
nothing. It's you could have gotten a $500,000 mortgage before. You can get a 525 now.
So it's super marginal. Hey, and the 489 number, sorry, that comes from where?
Well, the new calculation is somehow they're going to get a average of what banks are offering on 5-year fixed rates every given week. They're going to do an average. What does all the mortgages that are going out of these banks look like this week?
This is for prime lending, you mean? Because right now it's like less than 3%. Some people are 2.5. You guys are 2.38. Like what numbers are they taking?
Well, they're sure as hell not taking my rates.
Right.
They want the higher rates. They want the banks, and they don't even want the bank's best rates. They're going to look at the average rate the bank put out.
For insurable, uninsurable, for meaning like down payment wise.
Today, this whole discussion revolves around high ratio, less % down payment mortgages.
Okay, which are usually the cheapest mortgages because the mortgage insurance and yada yada, right? People like those are usually the lowest rates though. So I'm surprised we're getting 489 even on from the highest kind of mortgage because I don't see anything about 3.
This average, which is a false average, which is an average not of the best rates, but of the average rates that banks offer. Because let's face it, banks might be extremely competitive in Vancouver, Toronto, Calgary, Montreal, but they ain't too competitive in Medicine Hat. I mean, when the guy comes in for a mortgage, they say, yeah, that's 309. Because
oh, wow.
It's like a gas station. All the banks in Medicine Hat are 309. So you get an average that's not a very aggressive average. So it's the average rate that's been calculated that last week in Canada. God knows how they're going to do it. I don't have any idea. I don't ask. Okay. But the theory is the average plus 200 basis points plus 2%. 2%, yeah. It's they said last week, we believe that last week in Canada it was 289, even though I'm 238. And we're gonna add 2% to that, so that's 489.
Wait, so they're adding the 2%. I thought it was 489 as it was. That was the average. But no, it's 289 plus 2. So they're still doing a plus 2 on something.
Correct, but they're using they're trying to design the extraction of the data from sources that will reflect the higher rate.
Of course. Okay, no, that's good. I just all the news articles I saw, no one actually said what the average was. You're the first person to say it's gonna, as of now it's 289. That could change in the future, but no one wrote about that. So I was like 5.19. I just couldn't conceptualize. So that's really helpful. I appreciate you putting some light on that. And so the 289, just think every week it'll change. So literally, if you're a mortgage lender or
they just published today that it will change every week on Wednesday.
Wow. Okay, so that'll be interesting as far as sorry.
There will be a weekly announcement every Wednesday.
Wow. Well, more thing to talk about online, right? It's good for the marketers out there. It's good for adding variability, but I could see that being really stressful. Okay, so my next question was really around is this really a material improvement from what's already there? From your answer, not really. Now, if we extrapolate a little bit further, perhaps the new government or even just going on this path of being a little bit more flexible, is this a move in the right direction? Like, do you think that, eventually it's going to be, plus 1.5 from the average mortgage bank rates? Like, where do you, I mean, if we can take out that crystal ball, like, is this going in the right direction, or do you think we're going to retreat after there's another election, or, who knows?
Interest rates change every week, so they can't. They do. So I never want to pull out that crystal ball, because I've been, after 25 years doing this, I've been wrong as often as I've been right.
Sure.
Let's take this one central fact, though. A level of both consumer, but more importantly, government debt all over the world is at a record level. Mm-hmm. So who actually pulls the strings on interest rates? At the end of the day, it's the central banks of the world's large nations pull the strings on interest rates. Mm-hmm. If you're the central banker, if you're Paul here, or you're the Fed governor, or you're the governor of the Bank of England, or at the European Union, when you have this unbelievable level of both consumer and governmental debt, you're not motivated to raise rates. I mean, it's ridiculous. I mean, that's why there's a lot of discussion about low rates forever. Now, I'm not going to make that prediction, but I think that it's rational to say, take Ontario, for example. Ontario is the largest non-sovereign debtor in the world. In Ontario, there's more debt by the government of Ontario than any other state of the union, any other sub-national jurisdiction anywhere on earth. Mm-hmm. So if interest rates went to 7.5% for Ontario, there would be a beginning of the discussion of filing bankruptcy for the province, because you couldn't pay the debt. It's impossible. If the cost of the interest went up 3 times, mm-hmm. you couldn't pay. You'd have to cut back on services. You'd have to reduce pensions. It would be literally chaos.
Right.
So there's a lot of reasons why central bankers all over the world, the people who actually control these interest rates, mm-hmm. have real motivation to keep the interest rates down. Again, the concept is low for long. That is the concept. But hell could break loose at any time and things could change. But right now, the chances of 5% mortgage rates or 7% mortgage rates are frankly almost impossible. Mm-hmm. In the near term, in the next decade, in the next 5 years.
Okay. That's good to know. So if you were Trudeau and you could approach this stress test in your own way, let's say, how would you approach it?
I would never be Trudeau, but he can't do much. Trudeau can't do much. I mean, he came out with an election promise, sounded good, like every election promise. Right. Now it's come time to try to fulfill it, and he basically gave everybody a nickel. If buying power has gone from 500 to 525, right. How change the house you can buy in a material way? Right. I mean, mm-hmm. Just at the margins, there's no significant change whatsoever.
So what do you think is significant enough, knowing a bit of like the average mortgage size, especially in BC and Ontario? Like, is there a magic number that like you can apply Pareto's principle, like that you're seeing, 80% of everyone going towards a certain bracket, like what, 20%? Is there a sweet spot you think would be like a great threshold on affordability number, if there's anything top of mind?
There's so many other problems in both major cities, and even a growing problem in Montreal, and even a problem developing in Ottawa. Right. That there is 500,000 new Canadians come to this country every year. That's mm-hmm. programmed by the government. Mm-hmm. We have supply problems. In other words, it takes 7 years from the day you decide to try to build a condo building to have any ability of able to put people in it. And that's 3 years is just getting through City Hall and getting through the province. I mean, we have these incredible layers of bureaucracy, mm-hmm. which many parts of the world don't exist. If you want to build a condo building in a suburb outside of Houston, you could probably get all that permitting done in about 5 months flat. Wow. Like 2.5 years here. So we have supply issues for one.
Because of the red tape, or because there's enough, good good developers out there, like Brad Lamb and all them.
Brad Lamb is a developer. You know, there are big developers, but yeah, no, they are also cognizant of the fact that it takes so long. Why wouldn't we redeploy our capital to other jurisdictions? So if you, somebody like, for instance, Mattamy, who's a huge home builder in Ontario,
yeah,
just a year and a half ago, I said, I'm going to redeploy most of my capital to the States because I can't afford the planning process here. It's just too costly. It's much cheaper down there.
Sure,
yeah. But it all sort of boils down to government regulation in the end. I mean, if there's just overburdens of levies, costs, permitting costs, development levies, all sorts of different, just a book of like a telephone, no, sorry, most of your people don't know what a telephone book looks like, but like, let's say a very big book. Oh, they don't know what a book looks like. Okay, so let's say a very big
reading. Audible.
Papers, okay, that, that you have to go through just to get to the point of having the city approve your plans.
Right.
It's very, very complicated in these jurisdictions in the big cities in Canada. So what does that problem? We got a lot of immigration coming in, new Canadians, happy to have them, love new Canadians, want more new Canadians. We have a supply problem.
Yeah.
We have other weird things happening. For instance, Airbnb, short-term rentals.
Right.
So short-term rentals actually take away from long-term rentals because they're more profitable.
Sure.
And even stranger, developers start to build purpose-built buildings with 340 square foot units because they know they're never going to be lived in by a family or even by a single person. They're just going to be Airbnb'd out on the weekends because they're building it next to the Air Canada Centre. Right. And it's just part of an entertainment complex. It's a hotel. It's not really a condo building.
Right.
So, and this creates a problem because those are people buying those condos who could have bought a condo to rent out to a family or to an individual on a long-term basis, but it's not being long-term rental, so they force the cost of rents up. There's another issue both in Vancouver and here in Toronto where there are a ton of houses and a ton of condos that are empty. They're asking storage of people from offshore or their representatives, their outpost families here, who have bought these properties and they're just asset storage. They didn't want to keep the money in their country, so they came here, bought a place, and just left it empty. They didn't even rent it. There's 3 empty houses on my street in my subdivision, or on my street. They've been empty for as long as they've been there, 8 years. Okay, so that's obviously asset storage, but that takes away from local people wanting to live in the properties. I can show you, there's a guy who did a study of condos just out of his own balcony.
Yes, I've seen that on blog.
Time-lapse photography, okay? He proved that there are permanently empty condo suites in the city.
Right.
I'm sure you could do the same thing in Vancouver.
Right.
So these things force prices up. When you have just people who aren't interested in living in your country, but just want to hold assets here in the form of real estate.
Right.
That's an empty place that somebody should be living in, and that artificially increases prices. So we have many, many things that come to Toronto and Vancouver, and to a growing extent in Montreal and Ottawa, which contribute to lack of supply and force prices up. So what the government really should do is take the approach of, we need to decide how to do things that reduce prices, which is dangerous because all the people bought 5 years ago and are enjoying this massive run up in price, they're going to be mad if prices come down.
Right.
Today, you have to support people living in your communities. Mm-hmm. And the only way to do that is to have rational pricing on real estate.
Mm-hmm. And so that's the thing here. So as far as like, hey, how would you apply a better stress test? It sounds like, I mean, the issue isn't the stress, it's the prices, which then relates to the rates. But I mean, in relation to what you said around, well, if I could actually work on the supply issue, I would do what you just said. But then what about the actual stress test? Given today's scenario, I guess, does that change your answer as far as what you would do for the stress test?
Well, I am one of the few mortgage brokers who is not relentlessly angry about the stress test because I think there needs to be a drag on lending.
Uh-huh.
Yeah, there is one really fatal flaw in the stress test, and that is on renewals. There should be no stress test at all on renewal. It doesn't make any sense. It's anti-consumer. I've talked to the CEOs of all of these companies who have the data, and they express the fact that once somebody has been in the property for 5 years and made all the payments on time, their default levels are effectively non-existent.
Right.
They fall off. You can't even find them. They're so low.
Right.
The danger zone for any lender is refinance when the person is looking to take more money out of their house.
Sure.
Or move up buy when you want to buy a lot more house because your family's grown or your appetites have grown, and you might overstretch yourself. So for those people who've been in the house 5 years, been in the condo 5 years, making perfect payments, statistically, they are the best possible lending risk you could have. So there should be no stress test for those people. Those people should have the chance to go out and look for the very lowest rate they could possibly find because they're perfect borrowers.
Right.
And statistically not open to debate. It is a proven fact. I realize we sort of live in a post-factual world,
Right.
but that's something that you could easily prove. They are literally perfect borrowers. They need to get the best possible deal.
Sure.
Because what else in this country isn't going up in price? If groceries cost more every day, the restaurant costs more every day, 2 for a beer costs more every day. So at the end of the piece, we have to realize that this is the only hope for consumers to get a break.
Right.
Aggressive shopping for mortgage renewals, and they shouldn't be restricted in any way. If they got bad credit, sure. If they've lost jobs, sure. But they should not be restricted by an artificial barrier of a stress test. It's stupid.
Mm-hmm. Agreed. And hey, just to wrap up, if I'm a first home buyer or someone who's watching is a current homeowner who might be looking at a renewal or refinance, given I guess the news of the stress test and the fact that it hasn't been a massively different change from where it's at now, what should I keep in mind to be in the best financial position in the future as far as the way that I'm, looking at paying off my mortgage, or any kind of personal finance strategies that might be related to the stress test and how they can be in the best position?
There is not, with the single exception of continuing to lobby the government to remove the stress test from renewals. The stress test for renewals is a purely anti-consumer concept that is just pure laziness on the part of the government. They don't want to even bother to make the adjustment. So that's a key. That's something we should never take the foot off the gas on. There should be no stress test on renewals. Otherwise, it's a very tiny change. So when you're looking to qualify for a mortgage, get professional advice, make sure you've got written pre-approvals, be careful that they've actually looked at your income information and they really have thought through your situation.
Right.
Your first-time buyer, be cautious, make sure it's a very well-vetted pre-approval, and go out and buy your house. But there is virtually no change. I don't think there will be much change at all on April 6th as there is today in terms of how much house you can buy. It'll be a small change. The only minor positive that we're experiencing here, that if for some reason rates go super low, I mean, there was one time that we were placing 5-year fixed rate mortgages at 1.89.
Wow.
So that's about 2.25 years ago. So if the average went down to 2.29 or 2.39,
right,
that would drop down to 4.39, and that's measurable. That's almost a 16 or 18% variance from what it is today. So that would be real. That would be, you could really actually go out and find a bigger house.
Right. Well, let's hope it all trends that way, Ron. It's been a pleasure. Really appreciate you distilling some wisdom, and definitely I'll make sure to share this with our communities, and we'll definitely be in touch for an update in the future. And thanks again for your time.
Thanks again. Good talking to you.
You bet. Thanks so much. Bye for now.
Bye now.